The year began on a positive note, with markets showing strength driven by resilient economic growth data, easing inflation, and solid corporate earnings. However, market sentiment was overtaken in late February by the largely unexpected conflict in Iran and the Middle East. The resulting increase in oil prices added to inflation concerns and drove a broad risk-off sentiment. Australian shares were volatile over the quarter, ultimately finishing lower. Early gains were supported by firmer commodity prices and strength in materials and energy. However, these gains were offset by a pullback in March, with weakness across most sectors, with the notable exception of energy. International share markets also declined across the quarter, with the US, Europe, and China all finishing lower. Technology shares were a key detractor as investors reassessed some business models and the potential for AI-related disruption. Listed infrastructure was a bright spot, delivering positive returns as investors favoured the stability of earnings from infrastructure assets. Fixed interest markets were relatively resilient over the quarter. Bond prices lifted in February as more measured central bank commentary supported markets, before falling back in March as higher oil prices lifted inflation concerns and weighed on bond prices. Looking ahead, the investment landscape has become more complex, as expectations of falling inflation and interest rate cuts are being challenged by the ongoing conflict in the Middle East. The opening up of discussions between the US and Iran has provided some hope of a resolution and driven a recovery in equity markets in the first few weeks of April. However, there is still significant uncertainty in the near term. In this environment, we need to be alert but not alarmed. Experience has taught us that we must remain focused on longer-term fundamentals during periods of market volatility. While we can't say with confidence when this conflict will de-escalate, we can see clear incentives for all parties to work towards a resolution. In the meantime, we focus on companies with attractive valuations, predictable earnings, and lower sensitivity to higher energy costs. Infrastructure is a good example of such an asset class, with assets supported by long-term contracted cash flows, often with built-in inflation protections. Despite heightened market volatility, the foundations for long-term growth remain in place. Investment in AI continues to support productivity and earnings, and hard economic data remains robust. As ever, maintaining a focus on quality and resilience remains central to our process.